Good afternoon, everyone. Welcome to today's show. We're going to cover financial leverage today, which is a really good topic. I know you'll like this one, Jim. And when we talk about financial leverage, you might be wondering, what does that mean? And in most cases, financial leverage is, it's that process of borrowing money in the form of debt and then using that to increase your potential rewards on any investment opportunity. And it depends on what your business model is. If you're running a business, it could be business loans and things. Predominantly, we'll probably cover today buy-to-let property investment and using, the bank's money in form of a mortgage and things. And that's probably what we'll reference quite a lot, because that's what you've used, Jim, in order to build your buy-to-let business. There is other options, joint ventures, and you could, these kind of trainers and things do promote possibly using other people's money, but be careful about doing that. But yeah, predominantly, Jim, I think with your business model and buy-to-let, it's the bank's money, and that's been very successful for you.
Yeah. I spoke to a guy at the weekend, actually, who has over 60 properties over the last 5 years he's bought, and he's bought them all for cash.
All right, okay.
It's like, wow, well done. But it says you're missing a trick by no leveraging this and actually recycling that money and actually making even more money on the money. And he was like, well, I'm not really comfortable with that. And it's like, there's too much risk. And I went, no, you de-risk the whole thing. As you would de-risk the whole thing and actually understand how to look at that, the risk analysis involved in stress testing, then there shouldn't be a problem. Shouldn't be a problem at all. And then that means you've got access to money in order to buy more. And he says, but I've got loads of money lying about. I'm not really sure if he was just trying to boast or if he was actually trying to do something else. But yeah, I find it weird. He says, I've got other money I could buy and all the rest of it. It's like, I'm not caring if you've got other money. It's just like you're leaving an opportunity on the table. You're leaving an opportunity to leverage yourself to actually make even more money.
Yeah, it's interesting you bring that up. I mean, it's a good point, and it's something that I come up against quite a lot with. Sometimes when people are investing and they've got a fair bit of money there, they think that buying full out in cash is a better option. They don't have the responsibility of a mortgage and things like that. But then that's probably not grasping the process properly in terms of using the bank's money to leverage you and freeing up more of your capital to then reinvest and build even bigger or have more disposable cash rather than all tied up.
There's a number of factors around why people don't do that.
Okay.
And one of them is probably some historical in the past that they've had some sort of trauma connected to it about lending and borrowing, that sort of thing. Maybe know them, but maybe somebody they know. So it's actually caused a bit of a problem for them. So that's maybe one of the issues. And the other issues is just like they don't understand the financial model and how it works in terms of being able to stress test. They don't understand that process. Even worse, they were managing everything themselves.
So that's that and effort as well.
Yeah, and they thought, well, but it's easy for me and all the rest of it. It's like, yeah, it's easy, but it's all based on your ability to perform. It relies completely on you being there or being at hand in order for anything to get done. So if you're basically stuck in that loop, and that's when he says, oh, well, I didn't really want to grow any bigger than that. I went, yeah, that's okay. If that's not what you want to do, then that's fine. Stay exactly where you are. But you're losing an opportunity here. Now, let me explain about financial leverage.
Okay.
You buy, just say a unit at 100,000, make it simple, okay? Yep. And you buy 60 properties. So you're in for 6 million, okay?
Okay.
So you've got £6 million worth of properties. Now, in 20 years' time, let's assume, because this is an assumption, and but it's broad brush anyway. It could be quicker, it could be later, but averagely, 20 years' time, property doubles in value. Okay, so in 20 years' time, just with servicing the debt and servicing the property, make sure it's filled, then you're generating, you're creating another £6 million in wealth.
Yeah,
because you've got £6 million in capital. Okay. So over that period of 20 years, the £6 million, then divide that by 20, you're effectively making £300,000 a year for really just looking after the portfolio.
Yeah, for just making sure things tick over and the numbers are. Yeah.
So think about that. Okay. Now, if you leveraged yourself because you were in for 6 million, and you said, "I tell you what, I'll be very prudent about this. I'll do a 65% loan to value." This is what most banks favour: 65% loan to value.
Mm-hmm.
So if I divide that by 0.65, I think it comes to 9. What was it? 9 million. Yeah, 9 million.
Okay.
So basically, let me explain that. No. I'm talking rubbish here because it's 6 million, so it's 35% divided by. So 6 million divided by 0.35 equals you can then get 17 million pounds worth of property if you do a 65% loan to value mortgage, because you can take that money and then put it back in.
Release that
so you
money.
Get 70 million. So then instead of increasing your wealth by over 20 years by 6 million, you can now increase it by 17 million, which is effectively £850,000 a year.
That's
£800,000?
Yeah.
£850,000. It's the same money.
Mm-hmm. But because you've used the lending to leverage your position.
Basically, leaving 285% return on the table every year.
That's good.
Yeah, from 300 to 850,000 in terms of wealth creation. Not to mention the fact that you've got all these properties now. You've got more properties, and I'll tell you, there'll be some people out there that will immediately say, "Oh, that's going to give me a headache, all these properties, because I'll have to buy more and I'll be up to about 150 or something like that." Yeah, that's great, but you'll have more income coming in as well.
Mm-hmm.
You'll have diversified your portfolio. You'll have diversified your risk as well, because it won't be all in 60 properties. It'll be over 150 properties now. So therefore, if 3 or 4 properties go down, you'll go, it doesn't matter. It doesn't really affect my income. If you've got maybe 10 properties and you do it like that, and 3 or 4 properties go down, you've got a problem, because then you're reliant on that. So you can see how the scale allows you to hedge yourself against any fluctuations in occupancy rate, possibly an interest rate, but you can hedge that up front with a 5-year fixed rate deal, or rents as well, in case rents are different as well. So that's what you have to understand about financial leverage in terms of how you use it. It is a really good one. I mean, we could talk about time leverage, but I'm sure we'll come to that as well. So we'll probably pick that up in the conversation, because this could be a quick blog. But there's a lot more. There's a lot more to this in terms of leverage, in terms of how we should do it, how you can do it. But that's just broad brush. I mean, these are facts. Remember, these will happen, whether you expect it or not. It will happen just out of time.
It's interesting you say, do you know, this could really, we could probably do this in, 15, 20 minutes. It could be quite a quick blog, because financial leverage, I know especially to you, Jim, it's quite clear cut and precise, and you know how it works and how to implement it. But do you think a lot of people maybe overcomplicate it a bit? And that's why it's...
Yeah, but remember, they don't know what they don't know.
Mm-hmm.
And they don't know it's as simple as it is.
Mm-hmm.
Because they believe it's other complicated factors, or they just don't know. They don't understand the formula. It's like saying, I tell you what, give me the answer to Pythagoras' theorem, but I'm only going to give you the first variable. You know, it's a squared plus b squared equals c squared.
Yeah.
But I would say, ask you, what is the answer to c squared? But I'm only going to give you the variable for a squared. And it's like, well, how can I complete the puzzle then? How can I come up with the answer if I don't have b squared? I need the variable for b. Well, I'm not going to give you that though. So there's an incompletion in that person's thinking. They don't
like
know
how you meant to get the answer for something, or the solution, without having all the facts to get the answer.
Yeah, that's it. That's it in a nutshell. If you don't have all the facts, but they don't know they don't have all the facts, because they don't understand what it's meant to be. So they do need somebody to tell them that. This is why it's sometimes and I will endorse it. Sometimes it's good going to these introductory sessions with property gurus, but just be careful that they don't hype you up enough. You end up signing up to a session which actually costs you an absolute fortune, which you don't actually need just now. That's all.
Yeah.
But you get a lot of good information at the beginning because they're like, it's like casting your rod with your bait on it. That's what they're doing. The introductory sessions are a free session typically because it's like them casting a rod to try and get you to take the bait to reel you in.
Yeah, I mean, we touched at the beginning there about people buying completely for cash and thinking that that's the best way forward, and that's maybe some people are a wee bit old school and still believe in that, or maybe they just don't understand the financial leverage thing. But I think it's fair to say financial leverage is kind of a key part of any kind of financial market at the moment. You know, whether it's facilitating trading or whether it's funding property investment and things.
Yeah.
Financial leverage is the way forward. It's not this, let's just buy things outright for cash and have it all tied up.
This is why I spoke about 65% loan to value rather than 75% loan to value.
Yeah.
Because you're hedging yourself a lot more in terms of what happens if there's a price fluctuation.
You still
like
got
the credit crunch
tied up in there. Yeah.
I tell you, there's a ticking time bomb out there, and it's called Bitcoin.
Okay.
Think about that. Bitcoin, about the amount of money it's been invested in, effectively what is magic beans, for want of a better word. Jack and the Beanstalk and his magic beans, Bitcoin. Effectively, there's all that money being invested into Bitcoin, this hypothetical thing that you can trade.
Yeah.
And if Bitcoin goes poof tomorrow, all of a sudden, then all that money disappears.
So where does all that money go?
It doesn't. It disappears completely. Value disappears. So anybody that's based their circumstances or based their lending on the value of the Bitcoin, therefore, there's a collapse in the financial in a financial market because it will have. It never had, because there's billions invested in it now. It will have implications. So hence the reason why there's always not a reluctance to play it down too much, and there's a reluctance to play it up to a degree, is to sustain that supposed hypothetical euphoria around the value of Bitcoin, to keep it up at that value, because it's just like property, isn't it? If property prices collapse, banks have actually made their lending on the price of that value of that property. Therefore, if Bitcoin value collapses, then maybe people's circumstances and everything that they've done and lending that they've done as well has been based on the value of Bitcoin. No, there is people out there that lend on Bitcoin.
See, I think that's crazy. I mean, but
that's potentially a ticking time bomb. Yeah. If that was, because it is a volatile market still. And it can be affected somehow, but people like Trump has obviously legitimised it, and that can have a knock-on effect to the financial markets, which can have a knock-on effect to the banks. So there's an argument for all cash.
Yeah, well, I suppose it does then, yeah.
Because then you've got nobody to answer to if anything goes wrong. So I could see how that person is, but I mean, they're 30 years old. It's like, oh my God, it's like you're half the age of me. It's like you've got the whole world at your feet. Like, go for it. What are you waiting on? And why are you not using an agent? Why are you not getting people, a big team in to help you and do all the donkey work for you, so you're not needing to do anything except oversee? And I explained to him about the true value of his time.
And do you think he took that on board? Because your time is really the most important thing. What you spend your time doing, especially when you're trying to build and run a business.
Yeah, you're right. I think most people don't realise their time is the most valuable thing. I think most people think their time is the least valuable thing, because they've got an abundance of it at that point in time, because they've maybe not got anything else to do. They're maybe retired, or they've maybe got time on their hands. Therefore, it doesn't become a scarce resource, because you've got plenty of it. We all get 24 hours in a day. And if you're no filling these 24 hours, then to them, they've got plenty of time. It's only when it becomes a scarce resource, like when you're looking after your own property and you've got a larger portfolio, and then you then say, okay, I want to grow again, or I want to buy more. And it's like, well, where are you going to get the time to go and look at these things and go and buy property? So this was quite interesting. I then had the conversation with the person about their time, how much they think it's worth. And I honestly thought they were going to come back with the price of minimum wage at some point in time, in terms of what they thought their time was worth. And I said, do you know your time's worth about £20,000 an hour? They went, what?
What did they say? Yeah, I was going to say that was the reaction you would get.
They went, what? It's like, how could it be £20,000 an hour? I said, and they laughed. See what I mean about people don't know what they don't know. I said, your time's worth £20,000 an hour, or it can be if you choose to be. I said, because you're self-managing just now, so therefore it's probably not. It's not as good as that. So let me explain to you, how long does it take you to buy a property? And he said, oh, it takes me about an hour. I went, well, no. See, this is where he didn't understand. It takes me an hour. Oh, but no. But think about all the effort you've put in the beginning and the searching to get the right property and all the resources you put in to get that. For example, somebody that goes and sources, they're putting flyers through doors, they're knocking on doors, they're actually checking up titles on the land registry. That takes time. Yeah. So that's inclusive for getting that property. So if you get one property and you've done all that time and it takes you, for example, 5 hours to get that property, okay? So maybe it takes you 5 hours in total. I mean, it might take you 5 hours over 5 weeks, but it takes you 5 hours for that one property. You might get 10 properties and it might take you a week and a half full time to get 10 properties, but that's 50 hours, remember? So therefore, if you divide that by 10 properties, it's 5 hours of property. So think about that. So if you've got 5 hours per property to buy a property, and if you buy a property at 100,000, now, if you buy that 100,000, irrespective if you finance it or buy it for cash, which is a different return, remember, this is an easy reckoner to understand how your time's worth £20,000 an hour. Because what you do from there is you took 5 hours to buy that property. Then you hand it over to an agent who looks after it from then, and the rent pays for their fees. Therefore, and the bank possibly pays for the mortgage for that property, or you bought it for cash. That's a different equation, additional upon top of this, by the way, how you leverage that part of the financial equation. So what happens there is you bought that property at 100,000, okay? And then it's taking you 5 hours. And you're no longer involved in that property, really. You're maybe involved in the financial part. In other words, where's the rent this month? I'm going to have to lay out this amount of money. And that's just, I don't know, maybe an hour a month or something like that at the most, if I say. I mean, my portfolio, you know yourself. Yeah, I'll probably spend about an hour a month on it because everybody else actually runs it. So when you think about an hour a month for my portfolio, that's a good return for an hour. So when you think about that person, 5 hours, they bought a property at 100,000. Now, let's go back to what I said. Property increases in value, doubles in value every 20 years.
Okay.
The gurus say 10, and they say 15 sometimes, but I'm quite prudent and I say 20. So at some point in time, they will increase 20 years. It could be 25 years, it could be 15 years, whatever. But let's just say 20 years. So you've made 100,000 over 20 years. Now divide that 100,000 that you made in capital appreciation by the 5 hours. That's £20,000 an hour.
Yeah.
Now I hear you saying, but that's not £20,000 an hour all the time. And then my answer to that is, well, it could be, couldn't it?
If that was all that you concentrated your time on.
Yeah, it could be. If that's all you did and you concentrated on just buying property at that level and only doing that every single time and sourcing property, it took you 5 hours a week, 5 hours a week each time. So then you think of 40 a week, then you could buy 8 properties a week on average. And over the year, depending if you're taking holidays, then you buy 8. Then basically over the year, you're buying 47 times 8. That equals 376 properties a year. Now, 376, right? In order to that, so 376, and you've got 5, and you're taking it 20 years, so you've got 376. Oh, yeah, boy, this is going to be mental. So basically 376, and if you wait 20 years, multiply by the 100,000 is, wow, 37.6 million. And divide that by the 5 hours you had initially, because I think it is the 5 hours, then effectively with your time, you're making £20,000 an hour, but I think I've got a number about 7.5 million or something like that. I don't know.
That's taking, obviously, that's scaling it up, obviously, and that's thinking about, like you're saying, if you're doing so many deals a week. But I think the basis of that, the 5 hours spent to purchase £100 property, does really give you that clear picture of, right, okay, well, an hour of your time is worth 20,000 then.
Yeah.
And it makes it clear that where you allocate your time and what you do with it, what it's worth.
Now you could look at this and think that's la la land, and it is for a lot of people. But if you've got a fund that people pay into and they invest with you, then effectively you could probably do that if you've got enough resources in terms of financial capital. If you've not got a fund like that, then obviously there'll be a finite point where you stop. But then where you stop is where you can calculate what your return on investment is in terms of your time, in terms of what it's worth. And then you can do something else with your time to do, to go and do something else. It's entirely up to yourself. But that's just an example, and it sounds really weird, and it sounds way out there, and some people will not believe that at all. But could you imagine if it was somewhere in between? £5,000 in it.
Yeah.
I mean, how much are people making just now? Well, minimum wage is what, £12.50 or something like that?
12, yeah, 12.21, I think.
Okay. So instead of £12.50 an hour, you could probably make £250 an hour. Does that seem more reasonable?
Yeah.
This is all about what you think and what you believe is possible.
And do you think people maybe don't take it on board or don't believe it because maybe they don't think that they don't really fully appreciate their own self-worth? Do you know, like, £20,000?
Their mindset's not at that level yet. Mm-hmm. Remember to get the right mindset to understand the journey. It's all about climbing individual mountains, but they're on one big mountain overall. And it's getting to the summit each one every time, and then realizing you could actually go higher and higher and higher and higher. And then maybe in 20 years' time, you think, oh my God, how did I get here? Well, you actually just took a step at a time, or a summit at a time. You climbed a small mountain at a time. And these series of climbing small mountains. I mean, we talked about the last week's show about the fact that a 1% improvement every single day ends up being something like over a year, which is 365 days, which you think it is. It's going to be 365%, but it's not. If you compound 1% every single day, it comes to 3,700% or more.
Yeah, it's like the 1 penny every day. You add the 1 penny on each day.
You're adding another 1% on, and you're actually improving on the 1% of 1% every single day in conjunction with that. So you're adding 1%, but you're improving the 1% and compounding that every day for 365 days. That's why you get 3,700% or thereabouts. Mm-hmm. It's quite startling when you think about it like that. But again, these are all just learning opportunities over time that you understand based on someone else's information and someone else's teachings. I mean, these things aren't made up by me. I collate that from other people because I wouldn't be naive enough to think I could do this all myself without learning from someone else.
Mm-hmm. Yeah, and I like how you've made it clear there. Obviously, if somebody was dealing with like you say a big fund and had a lot of incomes coming into that, then they can be doing a lot of potential property sales and things, and then that's when their time worth would be like right up there about 20,000. But then, do you know, if you're doing it on a smaller scale, if you're doing property solely concentrating your time on that, then that would bring you to a lot higher hourly rate.
Let's take that a step more then. Okay. So if you're doing that full time, then if you're bringing in somebody else's money, then you've got to give them a return on investment. Mm-hmm. Who's going to produce the hours in order to do all that work in for them? And give them a return on investment and pay it out to them? Oh, it's going to be you. Well, you've obviously then completely devalued your time then, because you're now working on something which is less of a salary than what you could do yourself and actually sourcing and buying and sourcing and buying and sourcing and buying every single time, which is probably the most important acquisition. Source, buy, refurb, you get it on the market, decide whether you're refinancing it or you're keeping it as it is and get it rented. And then decide whether you're bringing money in, who's going to have to do that job to bring the money in, who's going to have to do the job to actually pay the money out to investors. These are all things. And that's why the money that you generate, not in wealth, I'm talking about the capital appreciation is what we talked about there the now, but the day-to-day income is generated by the rent that comes in. And that's what pays for all these costs. And then you might have some left over, which is a great investment overall for you to have to use to do something else. Maybe buy another property in your own name, or it'll be an incorporated company when you get to that state. There's no point in buying property in your own name anymore unless it's your house to live in. So that's the difference. That's what a lot of people out there do not understand.
Yeah, and I think it's the lack of knowledge about the financial leverage and what it can do for you, and using your time correctly, I think is what a lot of people fall foul to.
Mm-hmm.
I mean, there's a few key points about financial leverage, and although it does really amplify, your returns in terms of if you have a highly earning return on a buy-to-let property that you've used financial funding for out with your own capital, it can really amplify that return. But it could also sometimes point out the fact that you're maybe making losses. If your investment's performing poorly, then it could really amplify like where you're showing a loss there. So it can show you in both ways. Like if you've got a good investment, it shows you how you're doing well. But if the investment's not performing well, then if you're using funding, it can show you that you're making a loss there. So that's where you really need to make your figures right at the beginning and project really well before you actually purchase anything.
Yeah, and that's why we've done the stress test in previous, just the last couple of weeks, actually. So if anybody wants to know, just look back the last couple of shows that we did on wealth creation, and you'll actually see how we stress test before we make the investment in buying a certain property. I wouldn't say a certain property, I would say a certain value of a property. Certain price we pay for a property based on the stress test and based on the rent, the occupancy rate, the interest rate, the ADS, the legal fees, and the refurb cost as well.
If you want me to share it.
Yeah, the refurb cost as well. If you want. I mean, I'll not see much because I'm sitting on a mobile phone, but if you want to share something, it's entirely up to yourself. You can talk it through.
Yeah. So this one, sorry. Could you see that there?
Yeah. Well, I could just I can't see anything massive.
Yeah.
I mean, if you want to explain that, it's entirely up to yourself.
Yeah, this was a recent one that one of my investors were going to be looking at, and it was an £80,000 purchase, one property, and 6,400 stamp duty. The 25% deposit was 20,000. The mortgage rate I think was about 4.5%, and the arrangement fee was about 1.5%. I think it was about £900, and then
that's good.
Yeah, and then we'd put the rent, because I mean in that area just now we're doing 2-bedroom flats. I'd put the rent at 600. So that's what we're achieving. And then the cash per month after the mortgage was 371.63, which was quite good.
It's interesting that you said the rent's at 600. Now, minus that from what we were getting 20 years ago at 450. Yeah. In the last 20 years where we are, rents have gone up by 33%.
Mm-hmm.
What's inflation gone up by? Significantly more. And yet we get castigated at the fact that we're putting rents up too high and they're meteoric. And yet I was charging 450 20 years ago for a 2-bedroom flat, and now it's only £600. So rents have only gone up 33% since that time. 20 years.
Yeah, and so I do agree with you, the 20 years thing. I think 10's a bit short to be projecting 10 years. I think 20 is, and it's like, and it just reinforces then that buy to let, it's something that you need to be in for the longer game, to be honest. But yeah, that was a good example there that I'd done, and he's actually purchased that, and we've got that coming on the market, and we're going to be managing it for him. And
good.
And so yeah, but yeah, and he uses that, and that's on now on my recommendation to run it through that spreadsheet. But I done that one with him just to make sure, and we looked at that. There's a lot of leeway with that one. If it was ever empty at the moment, that's not going to be an issue for a certain amount of months and things. And if he's
in other words, when you say leeway, just to explain to people, there's a high tolerance level. That's a high tolerance level, which means basically that the occupancy rate could drop, and the amount of time the person's living in the property and paying rent That makes sense. That's the occupancy rate. So it could drop to a certain amount. In other words, if it was only 50% of the year you were getting rent for, it could maybe tolerate it that way. So that's the occupancy rate and the high tolerance. The interest rate could maybe go up.
Yeah.
And that stress tests an interest rate and how high it would go up before it breaks even. So break even is the point where it covers all the costs that you thought it was meant to cover, like, for example, the management fee, the repairs and improvements, and the interest cost as well. That's the break even point. Marginal costing is different. Marginal costing is what is the direct costs it will cover. In other words, the most important cost you always want to cover is probably the insurance, which is minor, but more importantly, the mortgage interest if you've got it on it. And that's the only thing. You have to have a lot of coverage for that in terms of money for the rent in order to cover the mortgage, but also have a significant amount of money left to cover things like property management and also repairs and improvements and insurance and incidentals that are needed over time.
Yeah, and you really need to take these things into consideration, because if you don't do that at the beginning, it's going to come back to bite you, because you're not going to be prepared if these things crop up.
Yeah,
and eventually during any process of buy-to-let, especially if you're in it for the long haul, you will go through different times in the market. If you're doing buy-to-let, sometimes it'll be, there's an influx and there's a lot of property and there's not as much tenants looking, and then you could have the reversal, which we're kind of at the moment. There's not a lot of stock. There's lots of people looking. So it does kind of
supply and demand.
Yeah.
So when supply and demand, when the price goes up, when there's more demand but there's less supply of properties, and the government's exacerbating that situation by frightening private landlords who are no one to invest in the market, or ones that want to exit pretty quick, because they just don't want to take the risk anymore. They want to put their capital somewhere else. This is where the people that say, "Oh, that's great," don't understand. It's like it's an investment. That's it. Like anything else, you assess the criteria. We're not here for a charitable purpose. We're here to make a return on investment. And for some particular reason, some people actually take offence to that, saying that you shouldn't own more than one home, and that's not fair on the people that want to own a home. But the people that want to own a home sometimes can't even afford to buy a home, not because of the landlords bought it, because they don't have the means to be able to buy it. In other words, they're maybe on benefits, or they're maybe on minimum wage, and where was the entitlement for someone to buy on minimum wage in the private rented sector, or the private market in terms of house sale? That's what the social housing sector and affordable housing sector is meant to be for. People that are on low wages, in order to help them out. Now, it's and I was going to say it's not through no fault of their own, but it is. It's like they've not made an effort to actually get to a certain educational standard or get to a certain job, and hone and develop their skills in order to be paid more and be valued more in order to be able to afford that. But there seems to be this rhetoric out there by some of these people. It's like, that's not fair. You've got everything and I've got nothing. It's like, but the person that's got all that is the person who actually went to university, took a student loan out, still paying it back, spent years and years of study to be a doctor. But that's not fair. You're a doctor and I'm no. And how can you afford your house and I can't? Simply the fact that they're getting paid more because they're a doctor. They've got skills that are valuable.
Yeah, you do find that attitude quite a lot. And I always find it so surprising how, landlords are completely vilified. It's made so difficult, and people have this approach that they shouldn't have X amount of properties. You should only have a small amount. And then on the flip side, you think, but then, so where are all these people going to live at the house that, like you say, maybe are undereducated or at a different pay level, and there's not enough social housing to house. It's just
because the responsibility for that lies not with the private landlord, but with the government. And it's the government's failure to provide adequate housing over the years and build adequate housing in order to accommodate for that. But then there's argument as well. It's like there shouldn't be a case where people shouldn't be paid that less in order for that to do. But then that means, as customers and consumers, we have to pay more money to enable them to get paid more salary.
Yeah.
And we don't want to do that. We don't want to pay more for a product. So therefore, that's why the salary is set at that for that person that maybe makes that product involved in it.
Mm-hmm. So
it's not, there's not a conspiracy to keep people poor. There's just like, this is all about supply and demand and economics and the capitalistic system that we operate in. And that'll not change because most people do not want that system to change. No one really wants change. No one wants change. They like to talk about it and they like to think it would be great to have that. But in reality, when the push comes to shove, they were asked to vote for it, they don't do it. Because it's not sore enough for them. It's not uncomfortable enough for them. They don't want to change because it's like, yeah, I'm okay as I am. I mean, I could have my gripes, but the fear, the unknown, that's what causes the problem. It's the fear of the unknown. It makes people stay where they are, even though it's slightly uncomfortable for them.
Yeah, you tend to find in any circumstance, if someone's comfortable where they are, they'll be quite hesitant to move unless they've got a driving factor to push them into something different or make a change.
Mm.
Yeah, definitely. So, I mean, in terms of financial leverage, let's look at, there's advantages and there's possibly some disadvantages. I mean, of course, the advantages are it increases your buying power, especially if you're a buy-to-let investor and things, and your buying power in terms of the financial leverage gives you to buy. It allows larger investments than probably, obviously, what your personal, in most circumstances, your personal capital alone would permit you to do. We spoke about doing cash purchases, which of course has benefits as well. But yeah, it gives you that access to opportunities, enables you to kind of pursue, more expensive investments, and that growth that you can have that has got a lot more potential when you're using other financial options rather than just your own.
Mm-hmm.
And then that in turn, as we say, produces higher returns and can amplify your gains on your investment, all while building something successful, and if it's property investment, and providing something that's much needed, not just in Scotland, I think across the UK at the moment, and then that's housing.
Yeah.
And then,
so just to be clear, as private landlords, we're built to rent us, but we're not primarily creating new homes. But again, that's down to the government in order to encourage private building companies to build new homes to increase the stock, and also build to rent as well to increase the stock, and also for them to increase the affordable homes and social housing through building to rent as well on the social side. So it's again, I come back to saying it's not a private landlord's fault, and private landlords don't make up a huge amount of the housing system. It's probably about, I think it's about 15% or thereabouts, 15, maybe 18, 19. Yeah. So it's not that much in terms of the housing stock, if that makes sense. There's a lot of owner occupiers, there's a lot of social housing, affordable housing, shared ownership housing. So these are all different things and all different tenures. In order to facilitate the benefits of the mix, if that makes sense.
No, that does make sense. I was going to cover, I mean, I don't know, I was going to say disadvantages, but then a debt repayment obligation, it's not really a disadvantage. It's something that you take on as part and parcel of having financial assistance. But debt, which includes obviously like your interest payments and things, these really need to be the first thing that you cover first and foremost, in terms of if you're investing in an investment and you're getting your return, these things need to be taken care of straight away. I mean, I think it goes without saying, obviously that is, but there will be some people out there that don't pay it so much attention or importance as it should be, which is silly, because then it just your whole thing will fall down.
What surprises me a lot in terms of property investment, I'm amazed at sometimes how some tenants will turn around and say, "Is it okay? I can miss the rent for the month," but yet they don't take into account. It's like, well, we can't go. Can you imagine if we went to our banks? Is it okay if I miss the mortgage payment for the month? And what do you think the answer would be?
A firm no.
Yeah, I know. Yeah. That's the thing. It's like, why? It's like so it's okay for a tenant to actually miss it, and that's acceptable in terms of our cultural understanding just now. But it's no okay for you miss it for the bank. And what's the difference? We're both lenders. We lend a property to someone, they pay us a return for the property. The bank lends us money to buy a property, and we pay them a return for the money they lent us to buy it. Same way of looking at it.
It's the exact same way of looking at it, yeah. Definitely. Also, do you know, something that I was want to talk about was insolvency risks. And obviously, if you're using lending and you've got maybe high levels of debt, that could possibly limit the cash flow and things, and then possibly increase your risk. So, I mean, there are ways and means of, you know, handling that in a better way than possibly some people have done and found themselves in the past.
Well, insolvency risk is all down to your stress testing in the first place, to make sure that you don't overexert yourself or over leverage yourself. That's what that's all about. Mm-hmm. So insolvency risks is actually all about overextending yourself. In other words, you end up getting a loan for a deposit that you don't tell the bank about, that you use and say it's a deposit from you, and then you get the lending at 75% loan to value. So effectively, what you're saying is you've got 100% loan because you're having to service the loan that you got from someone else to put down for the deposit because you had no money in the first place. Mm-hmm. So therefore, that could end up overextending yourself if you don't get your numbers right. And that's the difficulty. And now there's a news flash to most people out there that don't understand this, but you can only charge so much for your rent. You can't just put rent up and just expect to get it. There's a market rate, so you can't go beyond that.
I did a wee vlog about that. We spoke about this. I did a wee vlog about that the other week there, because some landlords and things, which they're a bit lost on where their actual property is priced in the market, because property rental prices they're all over the place, and it's because there's certain platforms and websites and things where landlords are getting to market their properties, and they're getting to choose what the market rent is, or
just making up stupid numbers,
advertised rent, and it is really made up. And then in turn, I've seen some inexperienced letting agents use these as comparables, whereas I would never include them because I know that they're not a true reflection of the market at the moment. It's just people making it up.
Yeah,
which is
some letting agents probably do it as a mechanism to actually attract landlords, thinking that they'll get more money for their property. But then when they go see that landlord, then they turn around to them and say, well, we could try at that level, but we'd probably only get this level. And then they go, yeah, that's okay. We can have a go and see how we get on. I mean, that's a deliberate mechanism to actually get a landlord on board, because it's unlikely that they'll leave unless it's a really bad situation. Because being with a property management company is more like having a bank account. It's just the same. It's just like you're reluctant to leave if everything, the majority, is okay, and it's just now and again there's a problem. Mm-hmm. So you tend to stick with the same letting agent for a long time until it gets really bad, and then that's when you go, right, I'm going.
Yeah. And when it comes to property valuations and things, I always tend to do it. I mean, overvaluing is just not the way to do that. And if they have an expectation that's higher than you think, I always recommend, I always stick to my guns and say, look, if we get a lot of interest and we've got people in good financial and earning positions, then we could possibly negotiate something a little bit higher off market. But I'm not going to put it on the market at that price, because I don't believe that's the true reflection of where the market sits at the minute. Mm-hmm. And when you explain it to them like that, and that's been successful a lot of times in the past when I do that if needed. But it's becoming more and more a common thing that I'm needing to do, because there has been this enhanced expectation from landlords because what they're looking at online, but it's not a true reflection of the market.
Yeah,
and I do find it they find it challenging, and that's when I think agents that have done this for a while and do know the local market, that's when they come into their own, because they could then, you could outshine somebody that's really inexperienced or just kind of faking it till you make it kind of thing.
Imagine if they bought the property based on the other numbers, though.
Yeah.
That's where it does cause a problem. This is why it's so important to speak to the right letting agents in the first instance and actually get the right advice on what property you should be buying.
I went through the spreadsheet with.
I mean, the last person I would be buying a property from is a sourcer.
Mm-hmm.
And I know it's, oh, but you're an estate agent, says the sourcers, but you're a sourcer, which is effectively like an estate agent. So, but the reason I say that is because, you know, their naivety or their desire to make the property and the numbers look more desirable in order for somebody to buy it is overwhelming, because that's the only reason they get paid.
Yeah, because their sole objective is to source the property, get the person to buy it, they get their fee. Whereas, like,
and it's like, that's me finished. It's like, I don't have any other responsibility from there to get my fee. And you could argue that about the estate agent market, the residential. We just want to sell the property so we can get the fee and done and dusted. That's typically what happens in a volume agent scenario. They don't bother about the end price. They just want you. They just want to sell. I heard it the other day. I heard that at the weekend when I was speaking to someone. They felt it was another agent. They felt they got an offer on their property, and the agent more or less forced them into taking it, even though there was only £500 more than the home report, and it was early days. And they felt that they could probably get more, but the agent had no negotiation, and it was because it was a family estate, and the rest of the family chose that agent on it was the cheapest, which effectively is the dearest.
Well, and then it shows you what you get. You get what you paid for, and then that's really the thing you end up losing. Yeah.
Going with the cheapest is often the dearest, because you end up losing at the end result. Because you'll maybe save a couple of £100 in the fees at the beginning, maybe even £1,000 you're saving at the beginning, but £1,000 to a really good skilled agent at the end is easily recoverable on the negotiation and the price that they're going to pay for it.
Yeah, and like you say, with the sales side, if you've got a volume agent, they will just usually push for that higher price because they don't have any interest in follow-on business. Whereas if you've got an agent who's looking for a client for life, they're going to do things in your best interest in order to do further business with you down the line. And it's the same with lettings as well. If you've got a letting agent who's sourcing a property for you and then going to manage it, they're not going to inflate the rental value, because it's going to cause them problems for letting and managing it further down the line. So, you know, keep that in mind. If you think this is a one-stop person that's going to be walking away once the deal's done, they might not have your best interests at heart. So, but yeah, we digressed a wee bit there, but that's all relevant information, especially if you're doing buy-to-let investment. But yeah, we'll round up on financial leverage, and I think what we've pointed out today is to do the initial, make sure your numbers work, do that risk analysis, make sure that you have, got the tolerance to handle a volatile market. If a volatile market and the conditions change, could you weather the storm? And that's
weather a storm.
Yeah, and that's where you'll get a really successful investment, especially with buy-to-let. And using, what I went through the spreadsheet with my most recent purchase for my investor. Leverage will amplify your returns, but it'll show you if you're not performing very well as well. And the other advantages there is that it opens up a lot of opportunities when you've got funding available to buy possibly more expensive investments, or have a lot more funding to do several investments rather than just buying one property. You could possibly buy 4 or 5. So yeah, I mean, these are all the advantages, and just always make sure you de-risk things right at the get-go, I think.
Yeah, I would agree.
Yeah, and have the right people on your side in terms of who is providing your information to you. Don't fall foul to people that just kind of put it out there without any credible background. That's probably the important thing. I think I'll leave it there.
Okay. No, nothing else.
Right, Jim, that's great. Thanks everyone for tuning in. Thanks for that, Jim. We will be back next Monday at 12:30 as usual, and until then, we will see you there.
Bye for now.